You are turning 65 this year, and somewhere along the way, someone probably told you to sign up for Medicare within 7 months of your birthday. That part is true, but there is a number worth hearing before you touch any of that paperwork. If you are married and both of you have hit 65, you can claim up to $12,000 off your taxable income this year. Not a rumor, not a workaround. A real deduction that did not exist a few years ago, and most people your age have never heard of it. Here is the number that matters just as much, and it works the opposite direction. If you keep contributing to your health savings account after you enroll in Medicare Part A, the IRS looks backward 6 months from the month your coverage starts. Every dollar you put in during that window becomes what the IRS calls an excess contribution, and that triggers a 6% penalty every single year until you fix it. A small slip-up in the paperwork order can quietly cost you money for years, without anyone telling you it happened. That number alone is worth pausing on, because most retirement content built around turning 65 spends all its time on the Medicare sign-up date and never once mentions it. None of this is intuitive, and most of the advice out there stops at sign up for Medicare and calls it done. So over the next few minutes, I am going to walk you through the exact order to handle your health savings account and Medicare so you never see that penalty. Then we will get into a Social Security decision that quietly moves tens of thousands of dollars, depending on when you claim it. And I will show you how that new $12,000 deduction interacts with something called the Social Security tax torpedo, because using it wrong can cost you more than it saves. If you are between 55 and 65, and you would rather avoid these mistakes than learn about them the hard way, go ahead and subscribe. I will keep walking you through the moves that actually protect your money. Picture this. You are still working at 65, still on your employer's health plan, and still allowed to put money into your health savings account. That is fine, as long as you have not enrolled in Medicare. The trouble starts the day you do, because the clock does not start that day. It starts 6 months earlier. Say you are 66 and you sign up for Medicare Part A in November. The IRS backdates that coverage to May, 6 months back. Any HSA contribution you made in those 6 months becomes what the IRS calls an excess contribution, taxed at 6% a year until you fix it. On the 2026 self-only contribution limit of $4,400 spread evenly across the year, that is roughly $2,200 caught in the window and a $132 penalty. Most people assume that is a one-time mistake. It is not. It repeats every year. The excess money sits there, and the earnings on it get taxed too. The real cost is not the $132. It is that most people do not catch it for 2 or 3 years, and by then it has quietly stacked up with interest attached. The reasoning behind the rule is not random. A health savings account is only allowed to pair with a high-deductible health plan, and the moment Medicare coverage starts, the IRS no longer considers you to have that kind of coverage, whether you feel like anything changed or not. The account itself does not care about your intentions. It only checks the calendar. I have watched this happen to someone who did everything else right. Mike, an engineer from Ohio, kept contributing the full HSA limit through payroll deduction the whole time he worked past 65. When he turned 66, he signed up for Medicare Part A and assumed the clock started that day. It did not. His accountant found the excess a full year later, after 2 rounds of the penalty had already applied. This is not a case of Mike being careless. The IRS does not send a warning letter when this happens. It shows up as a line on your tax return, and most tax preparers never think to ask whether you touched your HSA in the months before you signed up for Medicare. The system assumes you already know the rule, and nobody tells you. The fix is not complicated once you know it. Stop contributing to your HSA at least 6 months before the date you plan to enroll in Medicare Part A or before you file for Social Security, since that automatically enrolls you in Part A too. Do that, and the look back has nothing left to catch. But here is the part worth sitting with. That same HSA does not disappear once you turn 65. It becomes one of the more useful accounts in your retirement plan, and there is a second opportunity waiting right behind it, a deduction worth up to $12,000 for a married couple, but only if you understand how it plays against a different number hiding in the tax code. If you were born in 1960 or later, your full retirement age for Social Security is 67, not 65. Claim at 65 instead, and you lock in about 86.7% of what you would have received at full retirement age. That reduction is permanent. It does not correct itself later, no matter how long you live. Here is what that looks like with real numbers. Say your full benefit at 67 would be $2,000 a month. Claim at 65 instead, and you get $1,734 a month, a difference of $266 every month for the rest of your life. Claim early, and you do collect 24 extra checks before you would have started at 67, worth about $41,600 total. But give up $266 a month for long enough, and that head start disappears. Run the math, and the breakeven lands around age 80. I know what that number brings up. If you are not sure you will see 80, taking the money early feels like the safer bet, and that feeling is completely reasonable. Nobody wants to leave money on the table because they were too cautious to spend it. But claiming early is not free, even if you do not live past 80, because every cost of living increase after that gets applied to the smaller number. A gap that starts at $266 a month does not stay $266. It grows every year. Benefits get adjusted for inflation, because the increase is a percentage of a smaller base. I have run these numbers with my own father. He claimed at 62, the earliest age allowed, and when we sat down and worked through it, it came out to roughly $40,000 left on the table if he lives into his mid-80s. That was not an easy conversation, and it was not about him doing anything wrong. He needed the income at the time. That is a real reason, and it is different from claiming early, just because you are not sure the money will still be there later. Neither choice is wrong on its own. What matters is running your own numbers instead of guessing, and there is a piece of this that almost nobody talks about. Waiting until 67 to claim does more than raise your monthly check. It opens a window, the 2 years between 65 and 67, where your income is lower than it will likely ever be again in retirement. That window is exactly where a deduction worth up to $12,000 becomes useful, if you know how to use it, without triggering a different penalty hiding in the tax code. Here is a number most people your age have not heard yet. Starting with your 2025 taxes and running through 2028, anyone 65 or older gets an extra deduction of up to $6,000 off their taxable income. If you are married and both of you are 65 or older, that is $12,000 combined. It does not require you to itemize. It sits on top of your regular standard deduction, and you do not need to be collecting Social Security to claim it. There is a catch, and it is an income limit, not an age limit. The deduction starts shrinking once your income for the year passes $75,000 for a single filer or $150,000 for a married couple, and it disappears completely at $175,000 or $250,000. For most people in the first few years after they stop working full-time, income sits well under those numbers, which means the full $6,000 or $12,000 for a couple is sitting there for the taking. Now here is the part that actually matters. The 2 years between 65 and 67, before Social Security starts and before required withdrawals kick in later, are usually the lowest income years of your entire retirement. Low-income years are exactly when it makes sense to convert some of a traditional IRA into a Roth IRA, paying the tax now while your bracket is small instead of later when it might not be. For 2026, the 12% bracket for a single filer runs all the way up to $50,400 in taxable income. That ceiling applies to taxable income, not gross income, which is exactly why your standard deduction and the new senior deduction both matter here. They are what stands between your actual income and the number the IRS uses to decide your bracket. Between the two, you can shelter a meaningful chunk of a conversion and still land inside that 12% bracket. But here is the part that trips people up, and it is worth understanding before you convert anything. Once you are collecting Social Security, up to 85% of your benefit can become taxable, and the way that math works is not gentle. Once your income crosses roughly $25,000 as a single filer, or $32,000 for a couple, every extra dollar of income can drag another 85 cents of Social Security into taxable territory. A 12% bracket can end up behaving more like a 22% bracket because you are being taxed on the extra dollar and on a slice of a benefit you already earned. That is what people mean by the Social Security tax torpedo, and it is exactly why a large Roth conversion in the same year you start Social Security can quietly cost more than the deduction saves. I remember sitting at my own kitchen table one afternoon with a stack of tax forms, trying to figure out why one extra withdrawal had pushed the tax bill up by far more than the withdrawal itself. That is the torpedo showing up in real life, not just on paper. The fix is sequencing, not avoidance. Do the bulk of your Roth conversions in the window before Social Security starts, while the new deduction is already shrinking your taxable income, and you get the benefit of both without setting off the torpedo. None of this matters, though, if you get the mechanics of actually signing up for Medicare wrong. That is the last piece, and it carries its own permanent penalty. You get 7 months to sign up for Medicare the first time around. 3 months before the month you turn 65, the month you turn 65, and 3 months after. Miss that window entirely, and the penalty is not a flat fee. It is 10% added to your Part B premium for every full 12-month period you could have signed up and did not, and that penalty rides along with your premium for as long as you have Part B. Not 1 year. For life. Here is what that actually costs. The standard Part B premium for 2026 is $202.90 a month. Delay enrollment by 2 years without a valid reason, and you are paying a 20% penalty, an extra $40.58 every single month for the rest of your life. Stretch that out over 20 years, and you have paid nearly $9,700 more than you needed to, just in premiums, on top of what you would have paid anyway. There is one real exception worth knowing. If you are still working past 65 and covered by an employer plan through a company with 20 or more employees, you can delay Part B without a penalty. But once that coverage ends, you get a special window of 8 months to sign up, and missing that one is treated the same as missing the original window. Drug coverage runs on a similar clock, with its own penalty of 1% of the national base premium for every month you go without it. None of these numbers are negotiable once the window closes. The Social Security Administration and Medicare do not make exceptions for not knowing the rule existed. And here is where this connects back to everything else in this video. If you have a health savings account, enrolling in Medicare Part A is exactly what starts the 6-month look-back we talked about earlier. So the order matters. Stop your HSA contributions first, then enroll in Medicare, not the other way around. Most people do it backward, simply because nobody explained the sequence to them. I will be honest with you. Medicare rules shift depending on your state, your employer, and your specific coverage, and I cannot walk through every version of it in one video. But the 7-month window is the one rule that applies to absolutely everyone turning 65. Get that date right. Mark it on your calendar the way you would a mortgage payment, and you avoid the one penalty on this list that never ends. So here is what you can actually do differently now that you are turning 65, or already there. Stop contributing to your health savings account at least 6 months before you plan to enroll in Medicare Part A, so the backdating rule has nothing to catch. Look at the 2 years between 65 and 67 as a low-income window, and use it to convert some traditional IRA money to Roth, while the new $6,000 deduction, or $12,000 if you are married, is working in your favor. Think carefully about when you claim Social Security, because the difference between 65 and 67 is not just a number on a page. It compounds for the rest of your life. And whatever else you do, mark your 7-month Medicare window on the calendar, because that is the one penalty that never goes away once it starts. None of these moves are complicated once you know the order to do them in. Most people just never hear about the order, because the advice out there stops at sign up for Medicare and calls it done. Turning 65 is not the finish line the way most people talk about it. It is a set of decisions with deadlines attached, and getting the order right is worth more than most single investment choices you will make this year. If this helped you see something you were missing, go ahead and subscribe. I am Wes, and I spend my time helping Americans between 55 and 65 make sense of these decisions without the jargon. I will see you in the next one.